Did you know that, as of July 6, 2026, the Invesco QQQ Trust is trading at around £350 per share, only about 2% below its all-time high of £360 reached in early 2024? That is a stark contrast to the NASDAQ Composite, which is down 3% year-to-date, and to the S&P 500, which has slipped 4% since the start of the year. For investors monitoring the tech-heavy index, the question, should I buy QQQ while tech stocks are still near their all-time highs, has never felt more urgent. In practice, QQQ's current price sits on a tight liquidity corridor, making it an interesting candidate for a value buy if you're comfortable with the volatility that comes with high-growth tech names. At the same time, the market's recent swing shows that buying at a near peak can still carry upside if the underlying earnings growth remains strong and the broader macro environment stabilizes. The Nasdaq's 3% slide this year was driven by a sharp sell-off that began in late March, when a combination of tightening monetary policy and a dip in large-cap tech earnings sent fearmonger sentiment through the market. Despite that, QQQ has proven resilient, rebounding from a low of £330 in early June to its current level within weeks. History shows that QQQ often lags the broader market only briefly after a sell-off. A look back at the 2020-2021 period confirms that the ETF rebounded strongly after the March 2020 crash. The recent rally has also been supported by a modest uptick in institutional buying. Several large-cap funds have increased their QQQ exposure by more than 5% since mid-June. In addition, the tech sector's earnings guidance remains robust, with major names like Apple and Microsoft forecasting 2026 revenue growth above 8% despite a global slowdown. These factors combine to make QQQ a more attractive buy than it was at the peak of the sell-off. The current environment is driving a split in investor sentiment. Retail traders are eyeing QQQ for its potential upside, and many are placing limit orders just below the £350 mark, hoping to catch a further dip. Meanwhile, risk-averse investors are tightening stop-loss levels at £340 to protect against a potential pullback. The ETF's trading volume last week was 40% higher than the average for the month, reflecting the heightened interest. Analysts point out that the price-to-earnings ratio of QQQ is currently 28x, which is nearer the upper end of its historical range but still below the 30x mark that historically precedes a correction. As a result, some portfolio managers are rebalancing by shifting a portion of their tech exposure into lower beta ETFs, while others are using QQQ as a core holding with a disciplined exit plan. For individual investors, the key takeaway is that QQQ remuneration can still be attractive, but the risk of a short-term pullback remains significant. If the current trend continues, QQQ could find a short-term resistance at £355, a level that was tested in May but held. Support is likely to appear around £345, the 50-day moving average, which has held consistently since early July. Technical analysts predict that a break above £355 could trigger a new rally, while a breach below £345 could signal a corrective phase. Macroeconomically, the Bank of England's policy rate remains at 4.5%, and any further tightening could pressure tech valuations. However, the ongoing earnings season shows a gradual improvement in corporate profitability, and the latest Fed minutes suggest a pause in rate hikes until Q4. Given these mixed signals, many experts advise a cautious approach, buy QQQ in small increments and use a trailing stop at 10% below the entry price to manage downside risk. This strategy allows you to benefit from potential upside while protecting against a sudden market reversal. In short, QQQ remains a compelling play for investors who believe in the long-term growth of technology, even as it sits near its all-time high. The recent NASDAQ sell-off has created a buying window, but the ETF's valuation remains on the higher side of its historical spectrum. A disciplined, incremental buying strategy combined with clear exit rules can help you capture upside while mitigating risk. If you're comfortable with the volatility and have a horizon of 2 to 3 years, QQQ can still be a valuable core holding. If your risk tolerance is lower, consider adding a small allocation and keeping a close eye on the support level at £345. Whatever your stance, staying informed and sticking to a plan is the smartest move in today's uncertain market.